Before you start to invest in property, the very first thing you need to figure out is your investment strategy. We often heard people debating the pros and cons about capital gain versus positive cash flow strategies, and still don't know which one they should follow. However, in fact, it can be easily decided by your financial situation and investment goal. Cash flow is realized when you purchase an investment and hold on to it, and every month, quarter, or year that investment returns money to you. Cash flow investors, unlike capital gains investors, typically do not want to sell their investments because they want to keep collecting the regular income of cash flow. This strategy is based on purchasing properties that have relatively high rental yields. The rent or income received from these properties not only covers all of the interest, maintenance and other costs associated with holding or owning the investment property, but there is also money left over. This means that the investor has no out-of-pocket expenses. In most cases, to find a property where the rental income earned covers all the interest and costs associated with owning the property, you would have to buy low-value properties in small regional towns or high-risk properties like student accommodation. These property types will generally have slower and lower capital growth trends, however they provide excess cash flow to the investor. In reality, it might be more and more difficult to find a completely positive cash flow investment property. However, investors can still claim tax and negative gearing benefits to ensure the overall transaction is cash flow positive. Positive cash flow investment property might have slow capital growth potential, but the overall capital value will still have very high chance to increase in a long run. More important, positive cash flow investment properties have unbeatable benefits. Usually positive cash flow properties are more affordable. In an increasingly difficult lending environment, higher yielding properties can really help to get finance over the line. It also gives you peace of mind. Even if the value of the property drops after purchase, positive cash flow should still be maintained, providing the market has strong fundamentals and is not reliant on one industry sector such as mining or tourism. In conclusion, positive cash flow properties are more suitable to those who has limited budget but will hold on to the properties instead of selling them for long term. Capital growth is the amount by which your property appreciates in value from the purchase date until the day you sell it. Unlike rental yield, which refers to income you can potentially earn from an investment property right away, capital growth is profit that's only accessible when you sell. This strategy is based on purchasing properties that will probably have above average capital growth over the long term. They are generally expensive and located in prestigious, well-known and established areas with a proven history. The rental yield or return on these properties in most cases is very low in comparison to the price paid to acquire them. This strategy is also called negative gearing, meaning that the expenses associated with having the investment property such as loan interest, maintenance, rates etc. far exceed the rental income derived from it, which makes it difficult for the everyday investor to accumulate more than one or two of these types of properties in a lifetime. Buying property for capital growth only will mean that they are very heavily negatively geared. An example of a property that would fit into this category would be a two-bedroom apartment in St. Leonard's, with a purchase value of say $1,500,000 and an expected rental return of around $1,000 per week. The costs are much higher than the rent received, and therefore this property would cost the investor $600 plus per week to hold on to, subject to the loan size. So why do people chase capital growth instead of positive cash flow? Well, in the early stage of your property investment journey, you will need capital growth to provide equity to leverage into your next property. This can provide the springboard for your ongoing acquisitions. Without this equity growth, it's unlikely that you will be able to save for your next deposit quickly enough. And it's extremely unlikely that a positive cash flow property will accelerate your savings capacity in any significant way. While there is money to be made through capital gains, it's also important to note the risks. First, it's a formula you have to keep repeating over and over again. You have to keep buying and selling, buying and selling, and buying and selling, or the game and the income stop. Second, if the real estate market takes a nosedive, flippers, People who buy a real estate property and quickly turn around and sell it for a profit, or capital gains, can get caught with inventory they can't sell. As long as market prices go up, capital gains investors win. But when the markets turn down and prices fall, something nobody can predict, capital gains investors lose. Third, are there any areas guaranteed to have capital gain within a presumable period of time? Fourth, higher capital gain investment properties are often associated with high holding, transaction costs and transfer duty costs, etc. In conclusion, this strategy is more suitable to experienced investors who are well cashed back with higher risk profiles. If you were only ever going to buy one property in your life, you would buy for capital growth, no doubt about it. However, successful property investment should be part of a wealth creation strategy, not just purchasing one property in isolation. To create financial independence for your future, the key is to accumulate multiple properties before retirement. When you retire, the rental income generated from each property becomes your ongoing disposable income. In reality, it's a bit more complex than that, but you get the picture. A cash flow positive property simply won't provide the capital growth needed to acquire further properties, or it will do so at a much slower rate, and a capital growth property will mean you simply won't be able to afford to add to your portfolio again as quickly as you would like because of the high holding costs. When an investor is heavily negatively geared after 3 or 4 properties, it may be appropriate to look at cash flow positive properties to balance the portfolio. And likewise, when an investor is heavily positively geared, capital growth properties may be the solution, as they can use their existing surplus cash flow to fund the negative cash flow on the new property. The key, however, to expediting the expansion of your portfolio is to buy for both cash flow and capital growth, especially when you are in the early stages of property investing up to 3 properties. Real wealth and success in property investment is not derived from income but through long-term appreciation and the ability to leverage off each asset to buy further assets, providing you have the financial capacity such as cash flow to do so. The right property, purchased in the right location using the correct due diligence process, will only be minimally negatively geared after tax deductions and will have all the attributes to ensure future capital gain too. Before you make a movement on purchasing your next investment property, assess your current financial position, investment goal and your current investment portfolio to help you to make your decision. For more property and real estate related content, subscribe to our channel and give our video a thumbs up. I will see you in our next video.